Breaking down the US-Japan trade deal, tariffs, investments, and market access. Introduction. On July 23, 2025, U.S. President Donald Trump announced a landmark trade agreement with Japan, heralded as potentially the largest trade deal in history. This deal, finalized after months of tense negotiations, includes a 15% reciprocal tariff on Japanese exports to the U.S., a $550 billion investment from Japan into the U.S. economy, and expanded market access for American cars, trucks, rice, and other agricultural products. The agreement has been framed as a significant step toward rebalancing trade relations between the two nations, with the U.S. claiming 90% of the profits from the investment. This article provides a comprehensive analysis of the deal, breaking down its key components, the concept of reciprocal tariffs, the structure of the investment, and the implications for both nations and global trade. It also critically examines the claims and potential impacts, offering a nuanced perspective on this historic agreement. Background: U.S.-Japan trade relations. The United States and Japan have long been major trading partners, with Japan ranking as the fifth largest source of U.S. imports in 2024, exporting $148 billion worth of goods, primarily automobiles, auto parts, and industrial machinery. The U.S., in turn, exported $80 billion in goods to Japan, including oil, pharmaceuticals, and aerospace technology. Despite this robust trade relationship, the U.S. has consistently run a trade deficit with Japan, which stood at approximately $68 billion in 2024. This imbalance has been a focal point of President Trump's trade policy, which emphasizes reducing trade deficits through bilateral agreements and tariffs. The negotiations leading to the 2025 deal were fraught with challenges. Earlier in the year, Trump imposed a 24% reciprocal tariff on Japanese goods, which was paused for 90 days in April to allow for negotiations. By July, with no deal in sight, Trump threatened a 25% tariff on Japanese imports, including a specific 25% levy on automobiles, a critical sector for Japan, as auto exports accounted for 28.3% of its shipments to the U.S. in 2024. Japan, facing domestic political pressures and a rice shortage, was under significant pressure to reach an agreement before the August 1 deadline, when tariffs were set to escalate further. Key components of the trade deal. 1. 15% reciprocal tariff. What are reciprocal tariffs? Reciprocal tariffs, as outlined in the U.S.-Japan trade deal, refer to a trade policy where the tariffs imposed by one country on another's exports are matched or mirrored to ensure parity in trade barriers. The concept is rooted in the United States Reciprocal Trade Act, H.R. 735, which mandates that U.S. tariffs on foreign goods reflect the tariffs that foreign countries impose on U.S. exports. The goal is to eliminate trade imbalances by ensuring that countries with high tariffs on U.S. goods face equivalent tariffs on their exports to the U.S. In this deal, the U.S. agreed to impose a 15% tariff on Japanese exports, a reduction from the previously threatened 25% tariff. This rate also applies to Japanese automobiles and auto parts, which had been subject to a separate 25% tariff since April, inclusive of a pre-existing 2.5% tariff. Japanese Prime Minister Shigeru Ishiba confirmed that this 15% rate is the lowest among countries with a trade surplus with the U.S., giving Japan a competitive edge over other exporters like Canada and Mexico, which face higher auto tariffs. Implications of the 15% tariff. The 15% reciprocal tariff has several implications. For Japanese exporters, the reduction from 25% to 15% on automobiles is a significant relief for Japanese carmakers like Toyota, Honda, and Subaru, which have faced declining exports due to earlier tariffs. For instance, Japanese auto exports to the U.S. fell 26.7% in June 2025, extending a 24.7% drop in May. The lower tariff rate mitigates some of this financial pressure, though it still increases the cost of Japanese vehicles in the U.S. market. For U.S. consumers, higher tariffs on Japanese goods could lead to increased prices for cars, electronics, and other imported products. However, the 15% rate is less inflationary than the threatened 25%, potentially softening the impact on American consumers. For global trade, the deal sets a precedent for other countries negotiating with the U.S. By securing a lower tariff rate, Japan demonstrates that concessions, such as investment commitments and market access, can lead to favorable tariff terms. This may encourage other nations to pursue similar bilateral agreements, fragmenting the global trade order as countries compete for exemptions from Trump's broader tariff regime. Critical perspective. While the reciprocal tariff framework aims to level the playing field, it has been criticized for its oversimplification of trade dynamics. Tariffs are just one aspect of trade barriers. Non-tariff barriers, such as Japan's strict safety standards for automobiles and regulations on rice imports, can be equally restrictive. Moreover, the 15% tariff, while lower than threatened, still represents a significant increase from the 2019 trade pact, which allowed many goods to move duty-free. Critics argue that this could disrupt supply chains and increase costs for both nations. Particularly in the automotive sector, where integrated production networks span the US, Japan, and other countries. $550 billion investment. Structure of the investment. The most headline-grabbing aspect of the deal is Japan's commitment to invest $550 billion in the U.S. economy. According to Trump, this investment will create hundreds of thousands of jobs, and is structured such that the U.S. will receive 90% of the profits. Japanese negotiator Ryoshi Akazawa clarified that the investment includes a mix of equity and loans to support Japanese businesses in key U.S. sectors, such as pharmaceuticals and semiconductors. Specific details on the investment structure, timeline, and profit-sharing mechanism remain scarce, as no official documentation has been released. The 90% profit claim. The claim that the U.S. will receive 90% of the profits from this investment is both intriguing and ambiguous. Trump has not elaborated on how this profit-sharing arrangement would work, leading to speculation about its feasibility. Possible interpretations include profit repatriation agreements. The U.S. could negotiate agreements ensuring that a significant portion of profits from Japanese-owned businesses in the U.S. is reinvested domestically or taxed at favorable rates, effectively keeping 90% of the economic benefits in the U.S. Tax incentives and subsidies. The U.S. might offer tax breaks or subsidies under programs like the CHIPS Act or Inflation Reduction Act to Japanese firms investing in domestic manufacturing, ensuring that the economic gains, through jobs, infrastructure, or tax revenue, primarily benefit the U.S. Joint ventures. The investment could involve joint ventures where U.S. entities hold a majority stake, allowing them to claim a disproportionate share of profits. Economic impact. The $550 billion investment is poised to have a transformative effect on the U.S. economy, particularly in strategic sectors. Job creation. Trump claims the investment will create hundreds of thousands of jobs. While exact numbers are uncertain, investments in semiconductors and pharmaceuticals could generate high-skilled jobs in states like Arizona, where TSMC is expanding its facilities, and in biotech hubs like Massachusetts. Sectoral growth. The focus on pharmaceuticals and semiconductors aligns with U.S. priorities to reduce reliance on foreign supply chains, particularly from China. Japanese firms like Takeda, pharmaceuticals, and Sony, semiconductors, could bolster U.S. production capacity. Market reactions. The announcement triggered positive market movements, with the Nikkei 225 rising 2% and the yen strengthening, reflecting investor confidence in the deal's stability. However, long-term impacts depend on the investment's execution and the resolution of legal challenges to Trump's tariff policies, such as a May 2025 court ruling questioning their legality under the International Emergency Economic Powers Act, IEEPA. Critical perspective. The lack of transparency regarding the investment structure raises concerns. Without official documentation, it is unclear how the $550 billion will be allocated, over what timeframe, or how profits will be calculated and distributed. Critics, including trade expert Mary Lovely from the Peterson Institute, suggest that the 90% profit claim may be more rhetorical than practical, as international investments typically involve complex profit-sharing arrangements. Additionally, Japan's significant holdings of U.S. debt, $1.1 trillion, give it leverage, potentially complicating negotiations over profit repatriation. Expanded market access for U.S. goods. Automobiles and trucks. A central pillar of the deal is Japan's agreement to open its market to U.S. cars and trucks. Trump has long criticized Japan for limiting access to its automotive market, claiming that Japan blocks U.S.-made vehicles. However, data from the Japan Automobile Importers Association shows that Japan imported 16,707 American vehicles in 2024, a modest but non-negligible figure. The deal aims to increase this number by easing non-tariff barriers, such as Japan's stringent safety and environmental standards, which have historically made it difficult for U.S. automakers to penetrate the market. Challenges and opportunities. Challenges: U.S. automakers like Ford and General Motors face significant hurdles in Japan, where consumer preferences favor fuel-efficient, compact vehicles produced by domestic brands like Toyota and Honda. Even with reduced barriers, American vehicles may struggle to compete due to design and cost differences. Opportunities: the deal could benefit U.S. manufacturers with existing production ties to Japan, such as Tesla, which has a growing presence in the Asian market. Additionally, relaxed standards could facilitate exports of larger vehicles like trucks, where U.S. brands have a competitive edge. Agricultural products, particularly rice. Rice has been a contentious issue in U.S.-Japan trade talks, with Trump repeatedly highlighting Japan's reluctance to import American rice despite a domestic shortage. In 2024, Japan imported 350,000 tons of U.S. rice, making the U.S. its largest rice supplier. The new deal increases Japan's rice imports within its minimum access framework, potentially boosting exports from states like California, a major rice producer. Other agricultural goods. The agreement also opens Japan's market to other U.S. agricultural products, such as beef, soybeans, and wheat. This is significant given Japan's status as a major consumer of U.S. agricultural exports, with $298 million in rice alone purchased in 2023. The liberalization of agricultural trade is seen as a win for Japanese consumers, who may benefit from lower prices and greater variety, assuming cultural preferences for domestic products can be overcome. Critical perspective. While expanded market access is a boon for U.S. exporters, the deal's impact on Japanese agriculture is controversial. Japan's rice farmers, a politically influential group, have long been protected by high tariffs and quotas. The decision to increase U.S. rice imports comes at a sensitive time, as Prime Minister Ishiba's ruling coalition faces domestic backlash following a recent election loss. Critics argue that the deal may prioritize U.S. interests over Japan's agricultural sector, potentially alienating farmers and fueling political instability. Negotiations and political context. U.S. perspective. The trade deal reflects President Trump's America First economic strategy, which prioritizes reducing trade deficits and reshoring manufacturing. The agreement aligns with the United States Reciprocal Trade Act, using tariffs as leverage to secure concessions. Trump's rhetoric, including claims of the deal being the largest in history, underscores his focus on high-profile wins to bolster domestic support. However, the lack of detailed documentation and the contentious legal status of his tariff policies, challenged in a May 2025 court ruling, introduce uncertainty. Japanese perspective. For Japan, the deal averts the immediate threat of a 25% tariff, which would have further strained its economy. Japanese exports to the U.S. declined 11.4% in June 2025, and the central bank halved its growth forecast due to tariff pressures. Prime Minister Ishiba, facing a weakened coalition after losing its upper house majority, framed the deal as a diplomatic success, emphasizing its job creation potential and the 15% tariff as the lowest among trade surplus nations. However, Ishiba's cautious response, noting the need to examine details, suggests lingering concerns about domestic political fallout and the deal's long-term implications. Global context. The U.S.-Japan deal is part of a broader wave of tariff-driven negotiations, with Trump targeting countries like the Philippines, 19% tariff. And Indonesia, 19% tariff, while pursuing deals with the EU and India. The agreement with Japan breaks from Trump's initial template of sector-specific tariffs, e.g., 25% on autos, 50% on steel, suggesting flexibility in his approach. This could reshape global trade dynamics, encouraging other nations to negotiate bilateral deals to avoid higher tariffs, potentially undermining multilateral frameworks like the World Trade Organization. Economic and geopolitical implications. Economic impacts. U.S. economy. The $550 billion investment could stimulate growth in key sectors, but its success depends on execution and legal clarity. The 15% tariff may increase consumer prices but also incentivize domestic production, aligning with reshoring initiatives like the CHIPS Act. Japanese economy. The deal mitigates some economic pressure from tariffs but requires Japan to balance increased U.S. imports with domestic priorities. The Nikkei 225's 2% rise post-announcement reflects short-term optimism, but long-term growth depends on navigating trade tensions with both the U.S. Global markets. The deal's ripple effects include potential supply chain shifts, with Southeast Asian countries like Vietnam and the Philippines emerging as alternatives to China and Japan. However, retaliatory tariffs from Japan or other nations could exacerbate trade wars, impacting global economic stability. Geopolitical implications. The agreement strengthens U.S.-Japan ties, a critical alliance in the Indo-Pacific amid tensions with China. However, Japan's role as China's largest trading partner complicates its position, as it must balance commitments to the U.S. with economic ties to Beijing. The deal also signals Trump's willingness to negotiate with allies, potentially encouraging other nations to engage in bilateral talks rather than forming a united front against U.S. tariffs. Critical analysis and challenges. Lack of transparency. The absence of official documentation raises questions about the deal's specifics, particularly the $550 billion investment and 90% profit claim. Without clear terms, it is difficult to assess the agreement's feasibility or enforceability, leading some analysts to question whether it is more symbolic than substantive. Domestic political risks. In Japan, the deal risks alienating farmers and other domestic stakeholders, particularly as Ishiba's coalition faces electoral challenges. In the U.S., while the deal aligns with Trump's base, it may face scrutiny from lawmakers and businesses concerned about higher consumer prices and supply chain disruptions. Legal and trade policy challenges. The legal status of Trump's tariffs remains contentious, with a May 2025 court ruling questioning their authority under the IEEPA. The outcome of ongoing appeals, set for oral arguments on July 31, 2025, could impact the deal's implementation. Additionally, the shift toward bilateral agreements may weaken multilateral trade frameworks, complicating global trade governance. Cultural and market barriers. The success of expanded market access for U.S. goods in Japan hinges on overcoming cultural and consumer preferences. American cars and rice face entrenched competition from domestic brands, and changing consumer behavior will require significant marketing and adaptation efforts. Conclusion. The U.S.-Japan trade deal of July 23, 2025, marks a significant milestone in bilateral relations, with its 15% reciprocal tariff, $550 billion investment, and expanded market access for U.S. cars, trucks, and agricultural products. The concept of reciprocal tariffs aims to level trade barriers, while the investment and market access provisions promise economic benefits for both nations. However, the deal's lack of transparency, domestic political risks, and broader geopolitical implications raise questions about its long-term impact. As the U.S. and Japan navigate the complexities of implementation, the agreement will serve as a test case for Trump's tariff-driven trade strategy, with ripple effects for global trade and economic stability.